Texas Instruments is down 20% year to date, and in the past month alone is down about 10.2%. Now, analyst expectations for what this stock is going to do in the future is kind of all over the place at the moment. We have scenarios where some institutional investors are lessening their stake in Texas Instruments, and then we have banks that are changing Texas Instrument to hold ratings, but then we still have a lot of investors that are bullish on this company. So in this video, we're going to be jumping into my stock valuation spreadsheet to see if we can find the intrinsic value of Texas Instruments and decide if it's a stock we should be buying or selling. And on the spreadsheet, we have 4 different valuation models. We have Graham's valuation, a discounted cash flow model, multiples valuation, and a dividend discount model. And all 4 of these valuations are going to roll into our output tab. So let's go ahead and jump over to our stock screener. If you'd like to be able to download this spreadsheet, then you can head over to my Patreon page at the link in the description. So let's go ahead and come up here and plug in Texas Instruments stock ticker and hit enter. And we can see here, we have all of this data automatically load in. Now we're currently looking at a 1,000-day chart, so we can see where they had a huge run up, but obviously if we zoom in a little bit more, we'll look at a 250-day chart. We can see where there's been a huge decline as of recently. Let's come over here and look at the dividend data. We can see currently paying out $4.60 per share. Now dropping down to this price makes it a little bit more attractive because the dividend yield is now above 3%, which is a little bit higher than the average S&P 500 company. We can see the payout ratio is currently sitting at about 49%. So a little bit higher than I typically like to see it, but still not any red flag there. Now the 20, 50, and 200-day moving averages are all down as well, obviously because of the huge decline. 1-year return of negative 18.4% and 2-year return of 21.86%. Industry is in information technology, and analysts currently have a target price of $192 per share on this company. We can also see the institutional ownership is a little bit larger than I was expecting it to be at about 86.2%, so that is a good sign, and a beta pretty close to 1, so you know this company is going to follow the volatility of the market. But let's go ahead and jump over and look at our first valuation model, which is Graham's valuation. This is a valuation model invented by Benjamin Graham, one of Warren Buffett's mentors, and here is his formula for calculating intrinsic value. So we can see the first thing we need is our earnings per share, which is automatically listed right here for Texas Instruments. We're then going to multiply this by 7, which is the price to earnings of a company with no growth, and then we're going to apply our growth rate projection. Most analysts are applying a growth rate of about 10 for this company, and then we multiply that by 4.4, which is the average yield of AAA corporate bonds. Once we've multiplied all of this top together, we're going to divide it by Y, which is the current yield of AAA corporate bonds. And at the time of this video, it's gone much higher than it was earlier this year. It's currently sitting at about 4, and that gives us an intrinsic value of about $163 per share for this company. Now let's go ahead and jump forward and look at our discounted cash flow model. And for our discounted cash flow model, the first thing we need to do is apply a growth rate to our future free cash flows. Now, if we jump over to Texas Instruments, we can see they actually place a huge priority on their free cash flow. We can see their CEO, Rich Templeton, said the best measure to judge a company's performance over time is growth of free cash flow per share. We believe that's what drives long-term value for owners. So let's go ahead and put that to the test and see if that's what they actually believe. I've plugged in their historical free cash flow over the past 5 or 6 years right here, and we can see they had an average growth rate of about 10.09%, which is pretty solid, and that's the rate I'm actually projecting for them moving forward as well, which kind of goes along with their industry standards. Using that 10% growth rate, I was able to project forward the future free cash flow for this company and calculate the terminal value, which is the sum of all the future free cash flows past the year 2030. I then found the present value of all of these future free cash flows and added them together right here. I added the company's cash and cash equivalents and subtracted out their total debt to find their equity value. After I had their equity value, I divided by the number of shares outstanding for this company, and we can see our discounted cash flow model gave us a price per share of $195 per share. If we jump back over to our stock screener, we can see that's actually really close to what analysts' current target price is for this company. Now let's go ahead and look at our multiples valuation model as well. The idea behind our multiples valuation model is using a price to earnings multiple. We should be able to value this company based on how the market is valuing companies that are similar in structure to Texas Instruments. So we're looking at companies like ADI, QCOM, and NXPI. We're taking their stock price and dividing by their earnings per share to find their price to earnings multiple. We take the average price to earnings multiple and multiply it by Texas's earnings per share, and we find the stock price intrinsic value of $170 per share. Now let's go ahead and look at our dividend discount model. And the idea behind our dividend discount models, we should be able to value a stock based on how much they pay out in dividends and how much that dividend is increasing. So you can see I plugged in how much they've been paying out per quarter over the past few years to see their yearly dividend payout. This allows me to see the growth rate over each year, and we can see this This company has a really good average dividend growth rate over the past few years of about 16.8%. So that is phenomenal dividend growth. That's going to give you a really high dividend yield on cost if you were to invest in this company. Now we can see going forward, I am projecting a growth rate of about 6.5%. Now that is a pretty good dividend growth rate, but obviously not as high as the average growth rate of 16.8%. The reason behind this is their payout ratio is currently sitting at about 50%. So while that's not a very alarming payout ratio, I do think eventually in the future that's going to start slowing down because we're seeing a growth rate of about 10% in their future free cash flows. So while the dividend growth rate over the past few years of 16.8% is really good, it likely won't be sustainable for the foreseeable future. It might be high for the next few years, but it will slowly continue to decline over time. Now, after I apply a discount rate of about 9%, we can see our dividend discount model again gives us an intrinsic value of $195 per share, which is what our DCF gave us and was close to our analyst projection. Now let's go ahead and jump over to our output tab. And here on our output tab, we can see all four of our valuation models. We have Graham's valuation at 163, multiples at 170, discounted cash flow at 195, and our dividend discount model at 195 as well. When we average all four of these together, we can see we come to an intrinsic value of $181 per share. Now the current price of this company is currently sitting on $152 per share, so that's about a 16% difference. But as a value dividend investor, we do always want to apply a margin of safety to our investments. So let's say I'm a little bit more safe with my investments and I apply a 30% margin of safety. I'll hit enter and we can see based off of this, the acceptable buy price for this company is $127 per share. So our stock valuation spreadsheet is saying this is not a stock we should be buying. If we're a little bit more aggressive with our investments, let's say we apply a 20% margin of safety, we can see based off of this, our acceptable buy price is $145 per share. So the current price is $152, so it is getting pretty close to that acceptable buy price based off of our 20% margin of safety, but it's not quite there yet. Now, obviously, if you invest in this company, you are going to see good dividend growth, but there is the threat of an economic downturn over the next few months. So I have this company on my stock watch list currently, but I have not invested into it. It would be nice to see it go a little bit lower to get to that acceptable buy price and start to increase that dividend yield a little bit more. Maybe we could see that dividend yield a little bit closer to 3.25 or 3.5% in the next few months. But like I said, I'm going to keep them on my watch list and be ready to buy if it gets near that acceptable buy price. But go ahead and let me know what your thoughts on this company are in the comments below, if you own it or if you plan on buying it. If you'd like to be able to download the spreadsheet, you can head over to my Patreon page at the link in the description. So that being said, thank you guys so much for watching this video, and please don't forget to like and subscribe to the channel.